Hey, everybody. Welcome back to another episode of What's Going On in Banking. I'm Ron Shevlin, Chief Research Officer at Cornerstone Advisors, and I'm here, of course, with my colleague, Stacey Bryant. And I think we've got some really good topics lined up for you today. Some really hot stuff that's going on. And, of course, at the top of that list is, again, artificial intelligence, and things are going on. And, Stacey, I know you have been chomping at the bit to share some thoughts and things that you've been seeing and hearing. So take it away. What's going on out there?
What's going on, Ron? Yes, I have been traveling, been on the road, Stacey on the road, and I just got back from the Virginia Bankers and Maryland Bankers Joint Convention down in Naples, Florida. It was absolutely beautiful. Good to get away from the humidity of the New York City, New Jersey area for sure. But yeah, I want to kick off by saying the following, and then I'll segue into a quote that I found on LinkedIn the other day. But here comes the AI Zilla smashing the community banks' grounds that have been tested through their own generations of what they call innovation. So, Ron, we had a conversation the other day about AI and a chat that you had with our interns. You showed me your own curve graph that, as simple as it was, it provoked me to do two things: rethink the way that I look at AI today, and two, being able to guide my own community banking clients on the AI playbook of sorts. So on that curve, you showed me basically a tech revolution from PCs to mobile to AI, right? Could you quickly name that curve?
Oh, I think it was just I called it the productivity curve. And I said my point that I've been trying to get across to a lot of community-based financial institutions that this is not as much a revolution as you think. This is much more of an evolution from a productivity perspective. And look, when 45 years ago, PCs started appearing on everybody's desks, even though the government economists could not measure productivity, go ahead, turn those PCs off and see how much work got done or didn't get done. It caused huge amounts of productivity, but they were desktop bound. And it wasn't until the internet took off in the mid to late 90s that then collected a lot more information, and we had another big productivity boost. Then the iPhone was introduced and kicked off the mobile revolution. And then we got the cloud started taking off in the last 10 years. And all of that has laid the groundwork for us to now reap the benefits from a productivity perspective of a lot of the AI technologies. And especially now that new ones like generative AI and now agentic AI are emerging. So, this has really been an evolution, much less so than a revolution from a productivity perspective.
That again, it made me think about how to look at AI in another way. So it's the evolution. It just didn't pop out of nowhere, right? So AI during this entire time, like you said, where PCs evolved to now providing the internet then evolved to inputting information, then it went to like a mine of data. It equals now to this byproduct that we're seeing, the offspring, the baby that will grow hopefully stronger and can become really molded into a monumental shift in how we see the world today. So I'm at this bankers conference and we're coming out of a breakout session where the speaker, a college professor actually, provided a similar AI evolution timeline, Ron. And as we were walking out of the session, one of the bankers joked and essentially said, "Bless the hearts of those needing to think about an AI strategy in banking today, that he'll be long gone by then." So mind you, I too, along with our colleague Jen Wagner, as you know, had just presented the day prior on becoming a smarter bank by leveraging AI and tech. Ron, the session was standing room only. You'd be so proud. But what does that immediately tell me? At least the way I like to look at it. Despite the fear of AI, people are innately becoming more curious on frameworks to help them stay relevant and innovative during this uber competitive time. So our overall goal, while Jen and I were speaking, were to nudge these bankers on how they can realistically add AI onto their day-to-day, one pain point at a time, whether it be through chatbots, right? You broke it down in what's going on in banking, machine learning for analyzing fraud risks, for example, and that all of this can be incrementally added as a strategic initiative that won't break the bank, pun intended. So I think I think what gets in the way of progression in this space is thinking that they would need the budget of, let's say, a JP Morgan, a SoFi, or even Amazon to compete and stay relevant. And I'm getting passionate. I can see my New York hands coming through. But this segues into a quote that we just saw on LinkedIn not too long ago by, I think his name is Karen Kashiap, and he's a founder, I believe, of Posh AI. I believe they provide conversational and conversational AI through chat bots and texts for financial institutions. And he mentioned one thing in his post that struck me, and I'm going to just read it really quick. One common theme I'm observing across the banking industry is that while people generally believe AI is going to be a long-term transformative and it is advancing fast, we don't quite appreciate the rate of change or the steepness of this exponential curve. We're seeing with increasing frequency that things which weren't really enterprise feasible not too long ago because of resources, cost, quality, latency, etc., are becoming so in remarkably short time frames. He goes on to say, and he recites a famous quote that talks about our inability to really understand exponential curves. For example, exponential growth is deceptive, then sudden, then overwhelming, by Peter Diamandis. So this is because the exponent, he goes on to say, this is because the exponent of small numbers seem deceptively flat when zoomed out, but as exponential growth continues, it eventually and rather quickly, depending on the compounding factor, reaches the point where it becomes disruptive. Lastly, because the cost of doing nothing or self-inflicting delays could very well be existential. That was a mouthful. Talk to me as far as this rate that we're underappreciating right now change, and as it relates to these bankers who may or may not be interested or see see how they can implement AI today.
So it's funny. I think I'm kind of guilty of what Karan was commenting on and criticizing. I wrote something recently about how AI agents aren't ready for prime time, and I was drawing upon a study that Salesforce did of really they were CRM based agents and how there were a lot of issues. And there's kind of commented that they're not ready for prime time. And I had a lot of folks comment telling me, no, you're wrong. They are ready for prime time. Or Chris Nichols, and how many times do I mention Chris in this podcast? I tell you, just doing amazing work at South State. And his comment was, yeah, you are right, but the time frame by which they will become ready for prime time is moving a hell of a lot faster. But I think it's important for folks, Stacey, to kind of understand that there's different types of readiness. There's the tech maturity, and yes, that is happening so much faster than we've ever seen it. But there's also an organizational readiness, an industry readiness, a process readiness, and we can't just throw everything away and move to new stuff. The organizations, people don't move that fast. The processes can't change that, the interconnectivity. And look, if we get any one of our clients or any bank, community banker or credit union exec on, they're going to tell you, look, that's all great stuff and I would love to do it, but I've got this thing called the core system that's weighing me down. So yeah, I get where Karan is coming from. And he is absolutely right about the rate of change, but he's talking about the rate of change from a tech perspective, not from an organizational perspective, industry perspective, or process perspective. And so, look, it's going to take some time, but it amazes me that there are still banks and credit unions out there who are kind of taking a wait and see attitude, or even worse, those who say we're a fast follower. That is such nonsense. I can't even begin to tell you. There, you have to be really good to be a fast follower. So there's a lot of institutions, I think, kind of deceiving themselves on this. But I do think Karan's making a great point about the speed at which things are becoming enterprise ready.
I would argue with that Karan's quote may just be, in that particular vertical, so to speak. I think it can be applied just like in school. Just make the specific quote and apply it to, 3 examples that support it. And I think, when we think about these bankers, I think that it was during the pandemic, right, that a lot of these bankers were forced to transform digitally, Ron. And then that's when we saw the rise of digital transformation as buzzwords in every vendor pitch, so to speak. So now it's just like, if instead of being reactive, let's have these conversations and let's see from a banker's perspective as far as what are other folks doing and how can we just implement this chatbot, even if we choose to just keep it on for a year or 6 months, let's give it a test and learn. And we always speak about this in our past episodes, that test and learn, those marginal gains. And this is just another example. I think that if anything, the quote speaks on, let's be proactive and not reactive. We were forced to digitally transform during the pandemic. And now that we see it happening in front of us, let's flex this muscle as much as we can by learning, by seeing exactly what's happening, and by adapting. And by having that diversity thought from the very beginning, from a board's perspective, from all the stakeholders involved to actually make this move. So that's that for that. Go ahead and talk to me about this latest acquisition.
So yeah, I wanted to bring up the acquisition, Zero with an X, big accounting, cloud accounting firm, software provider, very big globally, not as big in the US as in some other countries, but internationally very well known. Acquired a relatively small company for a pretty big price, $2.5 billion, called Melio. That is basically a payments platform for small businesses that's focused on the accounts payable market. And that I had conversations with the folks from Melio a while back, and was always very impressed what they did. And I think the acquisition really caught my eye because first of all, I'm a big believer that the small business space in general is a huge opportunity for a lot of community banks and credit unions. I think not just from a lending perspective, but an opportunity to grow from a treasury management, banking perspective, payments perspective. A lot of pain in the small business space, and a lot of it is actually very accounting related. I don't know if you saw, Stacey, we actually did a study a couple of years ago for a company that's now called Tite. It was called Hurdler back then. They rebranded as Tite. And they basically do embedded accounting with APIs. And we did a study for them that really focused on the impact of accounting and technology from a small business perspective. And some of the findings were pretty eye-opening. First of all, accounting functions take up an absolutely inordinate amount of a small business owner's time. On average, I think it was something like 20 hours a week on just accounting functions, whether it's bookkeeping, invoicing, expense tracking, financial reporting, things like that. And then the second piece that was really, I think, important was that their use of accounting technology is very disjointed. They're using platforms, of course, like QuickBooks and Xero to do their bookkeeping, but using separate programs for invoicing, others for expense tracking, others for financial reporting, using other payment providers. It was all over the books. And so the acquisition of Melio by Xero is I think, a huge opportunity, not just for Xero to generate some more U.S. revenue, but to really, I think, the article I published yesterday on Forbes, I called it Supercharging Small Business Payments, because it's really going to integrate payments, especially payments that the small businesses make, into their accounting platforms. So once that's embedded into Xero users don't even have to leave the Xero app to make payments and pay their bills. So that's a huge, benefit to the small businesses. And I think it was important because I think it's just another step in the whole embedded accounting, embedded payments world that is threatening a lot of community financial institutions' relationships. Yes, they want the lending relationship, but to have a deeper operational relationship with small businesses from a payments perspective, whether it's accounts receivable or accounts payable, is huge. And if you take a look at the traction that Autobooks has gotten, more with an AR focus than an AP focus, but they're now doing things like providing capital. They launched just a few weeks ago. And within, I think, a couple of hours, Derek Sutton had posted on LinkedIn that within a couple of hours, they had already funded $90 million in loans to, and I might be totally wrong on that number, by the way. No, it was, $1 million to 90 small businesses. Yeah, I was close, 90 million. So I got the two numbers right. So they had funded these 90 businesses through their capital provisioning. So there's just this huge opportunity here. And I think it really goes to highlight the opportunity in the small business space. So that's why this acquisition caught my eye.
I think this is an important acquisition. I think I would use, and I think you touched on this in your on your LinkedIn post for this announcement. But I also think about I think it's Ashish Garg from Eltropy. He says the riches are in the niches, and I think that this can be this. This reminds me when I used to work at a supermarket, Ron, in Brooklyn, New York, and I was a bookkeeper. And the way that we did our accounts receivable and payable was, do you remember the general ledger books? And you needed a number two pencil and all the debits and credits. And if I made one mistake, I was done. I had to erase like all everything that we paid out and everything, all the receivables received, so to speak. So I think that when I'm on the road and I'm hearing, again, let's go back to bankers. When I'm hearing about growth, that's the number one obstacle. That's the number one rock that's standing in the way. This acquisition is a great example on how bankers can leverage on fintechs, how we can think outside the box, and add that as a sticky product, and how it can potentially be white labeled, so that you can focus on, you as in the bank can focus on small business banking and as that own value proposition that would set you apart from the bigger dogs, right? Or from your own competition. So that's the way I looked at this acquisition, and it's a good share.
Great. Hey, so I've got one third topic I wanted to bring up for today's episode, something that I'm sure nobody has heard about in months, maybe even years now, stable coins, right? Just for kidding, of course. Huge attention being paid to stable coins past couple weeks with the passing of the Genius Act, which I think for those of you who have not dug into the details of it, really does a couple of things. First of all, it really brings regulatory clarity to the whole stablecoin world by setting some capital and liquidity standards. It ensures that only depository institutions and those entities, non-bank entities that are approved, can issue stablecoins. They must be backed one to one with high quality liquid assets like U.S. Treasuries. It will require audits and disclosures of reserves, and there's some prohibition of algorithmic or unbacked stablecoins. So this just kicked off a huge storm of opinions and things about how Walmart and Amazon are now going to issue stable coins, and that consumers are going to put all their money into it, and that payments are going to migrate to stable coins. And I think, first of all, this is just way overblown. The BIS but they published a white paper the other day, basically saying that, look, stable coins don't even pass the test of really replacing money. They had, I think, 3 criteria, something like singleness, they called it, meaning that all money should be worth the same. The second was elasticity, meaning that the money supply should flex when needed. And the third had to do with security and privacy and preventing crime, fraud, and illegal use. And basically, according to the BIS's analysis, stablecoins don't pass the test. And even in the US, I think it's just way overblown, Stacey. I mean, we've got really good payment rails here, and I can see a lot more applicability for this in countries where you don't have strong payment rails. But I did write about this and wanted to comment that, from a U.S. banking industry perspective, there are some good reasons why a lot of community-based financial institutions should look at this. Number one, if they are supporting businesses with a lot of international money flow, there's a good use for stablecoin. If they are supporting consumer segments who are sending money back and forth to other countries, that's another good one. And then just in general, from a commercial payments perspective, the idea of stable coins and looking at what J.P. Morgan's done, what they've announced, they've announced their coin a while ago. Now they've introduced a tokenized deposit mechanism that will basically be like a stable coin, but backed by their deposits, not by Treasury. So it really isn't strictly a stable coin. So I think the hype around this is just a little too far out of control, although I do think that a lot of banks in the community segment should still be paying attention and be looking at what their role can be or should be, or what the role of stable coins can and should be in their strategies. What's your thoughts?
I have one simple thought, and it's another remark. It's a remark from another post where it's like the Kardashian effect on crypto, and the Kardashian effect and the celebrity effect on, now on, let's say, stable coins. My question to you, Ron, is: do you think J.P. Morgan's going to hire the Kardashians to to promote this? Like, the government obviously sees, just the increasing measures of, I want to say, beyond tokenization, right? On like the way we see money, digitization. So I just wonder how other folks will imitate and to what degree.
Yeah, you know what? You're bringing up another whole topic here, and we got a couple minutes, so let's delve into it a little bit. You bring up the Kardashians, and you remember Tom Brady did a commercial for supporting crypto. Well, I came across an academic research study this week. A couple of number of different professors from a couple of different universities, and they studied a bunch of like thousands of social media messages, tweets on X, posts on LinkedIn, to look at the impact of celebrity endorsements on crypto and what the impact was. And the findings were not very positive, Stacey. What they found was that, first of all, a lot of people were losing money based on celebrity crypto, and that not only that, but a lot of people, they were seeing jumps in trading volume in the hour or two following the ads or the comments that were made by these celebrities. One of the things that surprised me, though, was that one of the segment, the consumer segment that was most impacted by this were older, educated, affluent men. And I'm like thinking, wait a second here.
No
Um,
excuse. It's across the generational board.
It's like, wait a second. So it isn't just young folks. It's like it's. I don't know who it was, but that was really surprising and not a good sign.
Yeah, but that reminds me, like, even when we think about that demographic that you just mentioned, right? Like these older men, so to speak, I don't know why it makes me think of, what is it? The shoemaker's children go barefoot. I think these folks are so busy, and people are so busy. Here's a celebrity that for some way, somehow developed trust in their very own hearts, telling them exactly what to do in an age where this information is it could be tedious. So I think it's great, brand marketing, so to speak, not so great on the actual integrity of the information. And I think that this is why now more than ever, I even think about marketing on a greater scale, how companies really need to be intentional on how they market and the person behind it. I would appreciate, me, if I were following someone. I think it's John Hope Bryant, who's a self-made billionaire, so to speak. I would follow his advice, or the advice of our very own Ron Shevlin, who, this is what you do, as opposed to the Kardashian. But again, everyone has to decipher that, right? Everyone has a different gauge to that. I think it's just as good as, inputting prompts on AI and Chat GPT. One of my girlfriends, who's a doctor, a physician, she was mentioning to me that she saw on the news that Chat GPT and AI will replace doctors, and not necessarily. I think you need to know exactly, well, this is a pain that's occurring there. What does this mean in Chat GPT, as opposed to just getting a headache and now you're about to die? I'm not sure if that makes sense, but I think brand integrity is now of the utmost importance. If folks like any other, JP, for instance, or anyone, will go ahead and promote celebrities and intersect that with what, with the economy today. So I thought that was a super hilarious post. And you attach like documents, like official, it looked like court documents you were attaching to your post too, which that made it look more official, right?
Yeah, I was testing to see if posting the actual PDF of the report would drive more
Got it.
impressions
I'm
and
like, okay.
engagement. And the answer is no, that didn't do anything. And it was absolutely one of my worst posts of the month.
But Ron, look at you. You tested and you learned, right? Isn't that the whole point?
There you go. I'm living the Stacey Bryant advice: test, test, and learn. Test and learn.
There we go. There we go.
Awesome. So, you know what? Let's wrap it up for this week. And, keep your eyes out there, always open. Stacey, your ear to the ground. You always do. We'll pick up some great topics for next time. And listen, for everybody who is enjoyed listening in and has enjoyed today's What's Going On in Banking episode, please make sure to hit that follow button on Spotify, Apple Podcasts, YouTube, whatever platform channel you're listening in on. And we've got a lot more great conversations coming our way, and we don't want you to miss them. So thanks for tuning in, and we will see you next time.